We've seen Under Armour go through a phase where they've cleaned out their inventory. So give them kudos for that. Their inventory is under control here. However, if you look at the quarter, they were still incredibly promotional. And the story is that, hey, they're not going to be promotional going forward. And they're going to increase their operating margins by almost 700 basis points over the next several years. The problem with that is a lot of those assumptions come from growth in the international business. And as we know, Europe and certainly Asia is quite a question mark in terms of the demand side of the equation here.
Two ways to look at Under Armour. It was a $41 stock. It is now a $19 stock. That's bad. But it was an $11 stock about a year ago. So it's gone from 11 to 19. That's good. The market has said it's not as bad as it used to be. Do you believe the company at least is heading in the right direction, Stacey?
I do. I think that, again, North America, they've cleaned up the channel. They're closing those wholesale sale doors where we used to see way too much inventory that was always on sale. Who does that remind us of? There's so many retailers who have gone through this cleanup aisle 7 phase and pulled back from wholesale and said, hey, guys, we're not going to let you kind of just give our product away and kill our brand. But I think going forward here, again, the assumptions are mostly based on the international part of the business, which last quarter was less than inspiring. And again, so many issues internationally. Yeah. North America, if we see guidance negative in terms of revenues here, I think clearly the street is going to put the big question mark up again. Is this brand really dead?
Can you help me, help our viewers, help understand what's going on with luxury? Because here's the thing. We talk a lot about a Europe slowdown and a China slowdown, and we should. They're important things. Car sales maybe starting to come down. Yet, some of the luxury retailers, the LVMHs of the world, luxury cosmetics, they've been doing great. So that tells me we're not completely doomed. What are you seeing?
So here's the deal. We saw numbers from Estee Lauder, L'Oreal, LVMH, Kering today. They were all great. They're not saying that Asia has any sort of slowdown here. But here's the problem. So the Chinese are starting to travel less. So if you're highly exposed as a brand to Europe and you're dependent on that Chinese tourism traffic, you have a problem. If the Chinese are staying home and you already are a strong incumbent in luxury inside of mainland China, you are getting increased market share there. So these brands are telling us, the ones that are succeeding, that they're there. They're in China. They're incumbent. They're already strong loyalty brands there. So they're prepared if the Chinese start staying home more. However, there are other companies like a Tiffany that said there's been a bit of a slowdown. So far, everybody said things are okay. But again, if you're a tourism-based, depending on the Chinese coming to Europe or the States, then you have a bigger problem.
Give us a name you love. Are you still all about the Ulta right now, Stacey?
You know what? It's hard to ignore Ulta when you saw numbers out of Estee Lauder and L'Oreal like we just saw that were phenomenal. You're talking about 20-something plus comps out of Asia for the year. You're still talking about the consumers going after premium luxury products. They're willing to spend on quality rather than these fast fashion makeup brands. So I think Ulta here is intact, and listen to the vendors, listen to what they're telling you. And that's where you want to invest. In addition, I think, as we're talking about athleisure, you want to stick with Nike and Lulu here and not play the turnaround stories. Stick with the strongest brands out there with the margin stories.